Okay. So today we are going to be looking at sensitivity analysis. What do you mean by sensitivity analysis? The sensitivity analysis measures the tolerable extent to which a project NPV can accommodate any change in variable. I repeat, sensitivity analysis measures the tolerable extent to which a project NPV can accommodate any change in variable. It is also known as what-if analysis. Sensitivity analysis wants to know what is the percentage change in variable before a project will become unviable. For example, what if we increase initial outlay of the project by 5%? Can the project still be viable, right? If you reduce the selling price, if we reduce the selling price by 5% or 2%, can the project still be viable? This is what sensitivity analysis measures, okay? The tolerable extent to which a project NPV can accommodate any change in variable, okay? When you talk about variable, variables include initial outlay, right? Variable cost, sales volume, sales value, right? Incremental fixed cost, contribution, scrap value, all right? Examiner can ask you to calculate sensitivity margin of scrap value. You can be asked to calculate sensitivity margin of tax liability. Examiner can ask you to calculate sensitivity margin of working capital. All right. So these are variables, any component that make up the project being evaluated. So all those elements of the project, examiner can ask you to calculate sensitivity margin on them. All right. So you may be asked to calculate sensitivity margin on cost of capital. Not only that, examiner can ask you to compute sensitivity margin of project life. All these things you must know how to do it. What we are saying is that if any of what is the percentage change in any of these variables that will make the project NPV unviable, okay? What is the percentage change? What is the extent to what is the maximum change or increase or decrease in any of these variables that will make the project still be viable, such that at any point above or below the percentage attained, then the project may become unviable. So that is what sensitivity analysis measures. And not only that, this sensitivity analysis is very practical. You can use it for any kind of a business, whether be it manufacturing company, service company, whatever the kind of business that you do. Okay, you can apply sensitivity margin. In fact, for some of you that are familiar with Excel, okay, decision support system, when you look at the top menu of the Excel on your PC, when you look at the top menu, you are going to see what if analysis there. All right, so that is sensitivity analysis. Okay, so that is as per that. Now, how do you then estimate sensitivity margin of variables? There are basically three different formulas that you can use to calculate sensitivity margin of variable, depending on the variable that you want to calculate. For all these variables that we have here, excluding project life and then cost of capital, any other variable that you want to compute for, then sensitivity margin is the ratio of NPV to the PV of the variable, okay? NPV divided by the present value of the variable. So what that simply means is that for me to be able to calculate sensitivity margin of any of the variables, apart from cost of capital and then project life, that means I need to go and calculate net present value, because it is that net present value you are going to use as the numerator. Then you now use the present value of each of the variable as your denominator. Whatever you have thereafter will then represent the sensitivity margin of that variable, which represent the percentage change in that variable before the project will become unviable. Okay? Now, the second formula, examiner can ask you to calculate sensitivity margin of cost of capital. The sensitivity margin of cost of capital is computed as internal rate of return minus cost of capital over cost of capital. Again, from this formula, it means that we need to first of all calculate internal rate of return before we can calculate sensitivity margin of cost of capital. So you then go ahead, go and do working for internal rate of return. Once you are done with that, then you come and put it in this formula. You get your answer. It's as straightforward as that. That will tell you the percentage change in cost of capital before the project will become unviable. Then the third formula that you can use to calculate sensitivity margin of variable is examiner can ask you to calculate sensitivity margin of project life. You can call it project life or product life, depending on what the examiner is asking you to do. So to do this, the project sensitivity margin of project life will be computed as project life minus break-even points of project life over project life multiplied by 100%. Each of the formulas, your answer must be in percentage. You have to multiply everything by 100%. So these are the three different formulas that you can use to estimate sensitivity margin of variables. However, when you look at this, the third formula that you have here, which is sensitivity margin of product life, you will see that you have break-even points of project life, which means that for you to be able to calculate sensitivity margin of project life, you need to first of all go ahead and compute break-even points of project life. Once you are done with that, then you can come here to calculate sensitivity margin of project life. Let me see if I have a space here so that I can demonstrate for you how to estimate. Okay, let me use here. Now, what are the procedures to calculate break-even point of project life? Okay. Let me see. Should I use? Okay, let me just use it before I switch. So to calculate break-even point, let me calculating break-even point of project life. Okay. So to calculate break-even point of project life, there are three steps you are going to consider. Step one, you reduce the life of the project by 1. All right, reduce the life of the project by 1. Let's say, for example, if the useful life of the project is 5 years, you reduce it to 4. That is, you remove 1 from 5. So that means you have 4. Then step 2 says you should calculate net present value of the reduced life. Okay, calculate net present value of reduced life. Okay, so in my example, we are saying that, okay, if the useful life of this project is 5 years, when you reduce it by 1, when you minus 1 from 5, that means it will remain 4. That means you are going to calculate NPV for 4 years instead of for 5 years. All right, so that's what I mean by calculate NPV of the reduced life. Then step 3 says you should calculate break-even point of project life, estimate or determine break-even point of project life using the formula below. Okay. So to calculate this, the break-even point, just like the internal rate of return, break-even point of product life will be computed as reduced life plus net present value of reduced life over net present value of reduced life plus net present value of normal life. All of this multiplied by normal life minus reduced life. Multiplied by normal life minus reduced life. So this is the formula, just as if you want to calculate internal rate of return. Okay? Adeosun, what are you doing on my screen? Stop it. Okay? So these are the procedures for calculating break-even points of product life or project life. So that's that. At this point, now, note, when calculating sensitivity margin of sales volume, when calculating sensitivity margin of sales volume, the present value of contribution should be used as the denominator. Let me find somewhere to put that. Okay? It's not here. Let me just put it here. Notes. When calculating sensitivity margin of sales volume, the present value of contribution, let me shift. Present value of contribution should be used as the denominator. Okay, manage it like that. Let me see if I can still push to the front. Okay. So that's what you need to do. Anytime you want to calculate sensitivity margin of sales volume, you have to use the PV of contribution as your denominator. All right. What else? Now, the last thing we are going to discuss under this is the interpretation. Anytime you have computed sensitivity margin of variable, you must interpret your results. You have to interpret your result. It's not sufficient for you to just calculate sensitivity margin without telling the examiner what you mean by the figure that you have achieved. All right. In most cases, examiner will not tell you to interpret. All right. So you should know what to do because it is implied in the question that you are an expert. So especially at this level, so you have to interpret your result. And there are two ways of doing that. Let me look for space. There's no interpretation here. Let me look for a small space. Make sure I have space within it. No space. Let me go up there. Okay. Let me use it. Clean this one up. Now, interpretation. Oh, this space will not be sufficient for me. I would rather switch. Somebody is, let me check. Okay. Charity, you have started again, Charity. I'm too fast. Hey, I hear you. I'm always fast, Charity. Oh, don't worry, I will change. Hmm? I will change. All right.
Sorry, sir. It's just that part you were saying how to calculate break-even point of
Break-even point of
project
project
life.
life.
Yes, I do not
Okay.
get it all.
Oh, it's okay.
Let
I
me
will.
just screenshot.
Now,
Thank you.
so let me. So what I'm trying to say is that anytime you are asked to calculate break-even points, since anytime you want to calculate sensitivity margin of project life, of course, you need to first of all go and do working for break-even point of project life because sensitivity margin of project life is computed as project life minus break-even point of project life over the project life multiplied by 100%. So because you have break-even points of project life in the formula, you need to first of all go and do your working for break-even point of project life. To do that, there are three steps that you are going to carry out. The first step is to reduce the life of the project by 1, okay? You reduce the life of the project by 1. Then step 2, you calculate NPV of the reduced life. For example, like I said, if, for example, the life of the project, the useful life of the project is 5 years, when you remove 1 from 5 years, that means you are going to have 4 years. Therefore, in step 2, you then calculate the NPV for 4 years instead of 5 years. Then step 3 says you should calculate break-even point of project life. So this is the formula you are supposed to use to calculate the break-even points of project life, where, okay, where RL equal to reduced life, then NL equal to normal life. Okay, so that's that. Yes, Charity, are you fine now?
Yes, sir. Thank you so much.
You are welcome. So let me switch. I want to show you how to interpret your results anytime you compute sensitivity margin. So this space is not sufficient for me. Let me quickly switch to the working notes. Okay. So to interpret, I'll just come here interpretation. Again, examiner may not ask you to interpret, but it is implied in your question. Your calculation will be meaningless if you don't interpret what you mean by the figure that you have achieved. And that's why it is important for you to, to interpret your result anytime you compute for sensitivity margin. Now, like I said, to do this, there are two ways of doing it, depending on the variable. Okay? A, for variables, for variable such as sales volume, sales value, contribution, scrap value, or project life. Then how do you interpret this? When you have any of these variable, how do you interpret? So interpretation, you then say, after you have calculated your sensitivity margin using any of those formulas we've demonstrated before, all right? Then your interpretation should be that, let me rewrite this. Your interpretation should be that the variable should not reduce or fall, should not reduce or fall below the percentage attained. Otherwise, the project will not be viable. Okay? So let's say, for example, we have calculated sensitivity margin for initial outlay, and we got 6%. Okay? We have computed sensitivity margin for initial outlay, and we got 6%. So our interpretation is that the initial outlay should not increase. Okay, because this one I'm talking about all these variables. So let's say, for example, you calculate sensitivity margin of sales volume and you got 4%, for example, then your interpretation should be that the sales volume should not reduce below 4%. If not, the project will not be viable. That's what you need to say. What that simply means is that you can still reduce the sales volume by 4%. Anything higher than that 4%, the project will not be viable again. All right, so that's what we are saying here, because if your sales volume reduce by the percentage that you have attained, any further reduction will make the project to become unviable. So that's how to interpret any of these variables that I mentioned in A. Then for B for variables, including initial outlay, variable cost, incremental fixed costs, incremental specific or attributable fixed cost, cost of capital or cost of capital. Then the interpretation should be that the variable should not increase beyond the percentage attained. If not, the decision to accept the project may change. All right. If not, the project may not be viable. The projects will not be accepted. All right. So that's that. These are the two ways in which you can interpret your result. It's not compulsory that you have to do it the same way that I've said it. So you need to reframe just have the understanding on how to interpret your results. All right. If I like, I can say, for example, in this number B, I can say that the variable can increase further by a specific percentage. So that's how I can say the maximum increase in this variable is so percentage. Any further increase will make the project to become unviable. So you just have to frame it the way you understand it. But the bottom line is that you must know what you are doing. All right. So these are the two ways in which you can interpret your result. Remember what I said. Anytime you want to compute sensitivity margin of sales volume, you need to use the PV of contribution as your denominator. So that's that. And these are the concepts that you need to know as far as sensitivity analysis is concerned. So sensitivity analysis is also a measurement of risk. We use sensitivity analysis to mitigate risk. You want to know what is the extent of change, okay, in variable before the project will become unviable? What is the maximum level? What is the maximum or the degree of change in that variable that will make NPV to become unviable? All right. So that is what we are saying that you want to know the extent of change in variable before the project will become unviable. Okay. So let me stop sharing this and then move to the study material for calculation. All right. Let's have illustration number 4. Yes, illustration number 3. This is the question. It's been a while. Now, it's been a while ICAN tested a complete question on sensitivity analysis. What ICAN does in recent time is to just test one of the variables as a sub requirement. Examiner can ask you to calculate sensitivity margin. They won't mention it as sensitivity margin, but you will see it in the question that the examiner is referring to sensitivity margin. All right. So you can be asked to calculate sensitivity margin of scrap value or tax liability. About 2 years ago or thereabouts, the students were asked to calculate sensitivity margin of tax liability. That's a particular time too. It was on the scrap value. But the bottom line is that you must know what you are doing. All right. Okay, then. So let's have this illustration. Who is helping us to read? Yes. Who is helping us? Who is helping us to read?
Okay, I'll read, sir.
Yes, Wumi, thank you. Go ahead.
All right. Illustration 3. Tinapa PLC has sought your advice as a financial consultant on its investment proposal. It plans to diversify into the production of toilet soap. You are provided with the following information relating to the proposal. The initial investment in plant and equipment will cost 4.8 million naira. The plants are expected to have a lifespan of 10 years with negligible scrap value. The company plans to maintain a minimum of 80% of installed capacity each year. At this activity level, 240,000 units are expected to be produced. The annual production overhead, excluding depreciation, is estimated at 360,000 naira, while variable cost is planned at 18 naira per unit. The market research carried out favors settings. The market research carried out favor settings the selling price at 24 naira per unit. The company's cost of capital is 17%. You are required to advise whether the investment proposal is worthwhile. B. Calculate the tolerable level at which the following can vary without any adverse effect on the investment proposal. 1. Initial investment cost. 2. Production cost. 3. Sales price. 4. Sales volume. 5. Variable cost. 6. Product life, sorry. And then 8. Cost of capital. Annuity
Yeah.
formula is given as below.
All right. Thank you very much, Wumi. That is the question. The examiner is asking you to advise whether the investment proposal is worthwhile, meaning that you want to calculate NPV. So I will stop sharing this and move straight to solving the question. We want to calculate NPV. Okay. Solution to illustration number 3. Okay, that's page 63. So what are you supposed to do? We want to calculate NPV. So number A, calculating net present value, figures in thousands. So I will create a column for year, description of items, cash flow, discount factor. According to the question, cost of capital is 17%. Then present value. Year zero. The useful life of this project is 10 years. So I will do year 1 to 10. Before this, I will need to go back to the question. According to the question, we are given selling price to be 24 naira. We are also given variable cost to be 18 naira. That means we need to calculate contribution per unit. Once you have the contribution per unit, you then multiply with the number of units sold. That will give us the total contribution, which represents annual cash flow, right? So if that is the case, I will go and do working. Without going too far, let's start from here. Let's do the working here for that number A requirement. So I want to calculate contribution. Okay. So contribution per unit is computed as selling price minus variable cost per unit. So contribution equal to 24 naira minus 18 naira. So contribution per unit is 6 naira. Okay. Contribution is 6 naira per unit. Then total contribution will then be equal to contribution per unit multiplied by the units sold. So 6 naira multiplied by 240,000 units. What do you have here?
1,440.
1,440,000. Okay. So because our figures are in thousands, then we are going to recognize 1,440. So year zero is initial investments. Initial investments, which is 4,800,000. Discount factor at year zero is 1. Present value of that, 4,800. Then year 1 to 10, we have annual contribution, which is 1,440,000. Then we also have year 1 to 10 production costs. Annual production costs, excluding depreciation, which is 360,000. So we need to calculate annuity factor of year 1 to 10 at 17%. What do you have?
$4.659.
4.659. That's the annuity factor of year 1 to 10 at 17%. Okay. All right. So give me the present value for each of contribution and production costs. 1,440 multiplied by 4.659. What you get?
6709.
6709.
1677.
1677. So the difference would then be
232.
232. NPV is equal to 232. So examiner is asking you to advise whether the investment proposal is worthwhile. Because the NPV is positive, it means that the investment proposal is worthwhile, is financially viable, considering the positive net present value of 232,000 naira. Therefore, the investments proposal should be accepted or undertaken. Okay. So we have answered requirement A. We then move to requirement number B. Examiner is asking you to determine the tolerable level in which any of those variables can change. All right. So to determine the tolerable level at which the following can vary without any adverse effect on the investment proposal. So you can see examiner asking you to calculate the tolerable level. Examiner did not mention that you should calculate sensitivity margin. It is implied in the question because we said that sensitivity analysis represents or measures the tolerable extent to which a project NPV can accommodate any change in variable. All right. What is the percentage change in any of these seven variables before the project will become more viable? That's what examiner wants us to do. So let's pick it one by one. The first one is initial investments. So number B, Roman figure 1, sensitivity margin of initial investments. Sensitivity margin of initial investments is computed as NPV, net present value, divided by present value of initial investments, multiplied by 100 over 1. So NPV we calculated 232. The NPV of initial investments we calculated 4,800. Okay, this is the PV of initial investment, 4,800. All right. So here will be 48 multiplied by 100 over 1. Give it to me. What you get? 232 divided by 48.
4.8.
4.8%. Pay attention, please. What this simply means is that the initial investment of 4,800,000 can still increase by 4.8. That is the maximum level to which the initial investment can increase. Any increase beyond this 4.8%, the project NPV will be negative, which means the project will not be viable. So that is what we are saying here. I would then say the initial, I need to interpret my result. In this question, examiner did not ask you to interpret your result, but it is implied. Okay? Therefore, I would then say the initial investments should not increase beyond 4.8%. Otherwise, the investment proposal will not be viable. Okay, so that's the interpretation. If I like, I can say the initial investments the maximum increase in initial investment is 4.8%. Therefore, the initial investment should not be allowed to increase further beyond this. If not, the project will not be viable. However, you want to put it, just interpret your results. Okay, then hi. Number 2, somebody sent a message. Let me check. I'm fast. Okay. Yes, the second point, the second requirement, the second variable is production cost. Charity, always ask yourself a question. We've been in this class for almost three months now. You know me. So if you have any question, if you have any concern or anything that is not clear to you, speak up. Don't say I'm fast. That's the way I've tried to adjust myself. That's me. All right.
No,
So
sir,
just
I didn't write it again. It was just that first time that you've
it's
answered
there now.
me.
You just send this one now.
No.
Uh, maybe I'm seeing
Yeah.
why. Maybe I'm maybe I'm seeing why because
No,
I
I
saw the
didn't first.
message.
No, it was that first one that you helped me out in that BP.
Oh, okay. I saw you. Okay, I just saw the message now. So you are asking that I should scroll down.
Yeah.
Oh, okay. It's all right. No worries.
Thank you.
You're welcome. So then the second one is sensitivity margin of production cost. So sensitivity margin of production cost is the same formula. Remember I said I gave you 3 different formulas and I told you that all the variables apart from cost of capital and project life is the same formula that you are going to use. So provided you are not calculating for cost of capital and then project life, the formula will still remain NPV over the present value of variable. So NPV is 232. Then present value of production cost in this question is 1677. Okay, this is 1677. All right, 1677 multiplied by 100 over 1. Then this will give us 232 over 1677 multiplied by 100, 13.8%. So 13.8%. So which means that the production cost should not be allowed to increase beyond 13.8%. If not, the investment proposal will not be accepted. Or will not be viable. What we are saying here is that the production cost of 360,000 naira can still increase further by 13.8%. So what that simply means is that at any point above that 13.8%, the NPV will be negative. So the maximum tolerable level that the NPV can accommodate any increase in production cost is 13.8%. Any further increase beyond this 13.8%, the project will become unviable. That is, NPV will be negative. So at your own convenience, you can practice this. So all you need to do, for example, for this production cost, for example, I can say the production cost of 360,000, all right, we increase by 13.8%. So that would be 1.0138. Okay, 1.0138. That's 13.8%. All right. So you then multiply this one by 360. So you are going to have whatever you have, you use it to compute your NPV again. You will see that whatever you are going to have thereafter will be zero NPV. It will make your NPV to break even because that is the maximum level. So at any point above the percentage that you have attained, then the project will become negative. Your NPV will become negative, which means the project will not be viable again. So that is what we are trying to say here. In the first one that we computed, initial investment of 4.8 million naira, you can still increase that initial investment by 4.8%, meaning that you just do 1.048 multiplied by 4,800,000. You then whatever you have, you then use it to compute your NPV. Your NPV will be zero. So which means that at any point above that percentage that you have attained, the project will become unviable. So this is what we are trying to say in essence. All right. Then let's move to number 3. Number 3 is sales price. Okay. Sensitivity margin of sales price will be equal to the NPV of 232 over the present value of sales price. We don't have the present value of sales price, therefore we need to work it out. Okay, instead of me to be switching from pages, let me just put it here. All right, so I can then calculate the PV of sales price. Let me use here PV of sales price. We don't have this PV of sales price available, so we need to go and do working for it. So to get the PV of sales price, you need to first of all calculate total sales. Our sales will then be equal to selling price multiplied by units sold. So sales will be equal to 24 naira. Selling price is 24 naira multiplied by 240,000 units. So total sales will then be equal to 5,760,000 naira. To now get the PV of sales, the PV of sales will be the total sales of 5,760,000 multiplied by annuity factor. And we calculated annuity factor to be 4.659. So let's multiply. What do you have?
26 million
26 million
835,000
835
840.
840. That's it. That's the PV of sales price. So I will then come here 26,836. Our figures are in thousand. So multiply by 100 over 1. So what do you have here? 232 divided by 26,836.
0.9.
0.9%.
6.
Okay, so this means that the sales price should not be allowed to fall. Your selling price should not reduce below 0.9%. Okay, so interpret the sales price should not reduce or fall below 0.9%. Otherwise, or if not, the investment proposal will not be viable. So that's the interpretation. All right. So what we are saying is that the selling price of 24 naira, for example, we can still reduce it. We can still reduce it by 0.9%. So any further reduction in selling price beyond this 0.9%, the project's NPV will become negative. That means the project will not be accepted. So that's the interpretation of our sensitivity margin of sales price. Then number 4, you have to calculate sensitivity margin of sales volume. And I said that when computing the sensitivity margin of sales volume, the PV of contribution should be used as the denominator. So here will be NPV of 232 over PV of contribution 6709 multiplied by 100 over 1. Give it to me. What you get? 232 divided by 6709.
3.5.
3.5%, which means that the sales volume of 240,000 units can still reduce by 3.5% and the project will be viable. However, at any point beyond this percentage, if you reduce it beyond 3.5%, it means that the NPV will become negative, which means that the project will not be viable again. All right, so that's what we are saying. So if you want to put this into practice, you can say 240,000 units. Okay, that's the sales volume. Then multiply by, so you want to reduce it further by 3.5%. So this will be 100% minus 3.5%, which means that you have to take 96.5% of these 240,000 units. You then use it to compute your NPV. What you are going to get is 0 NPV. That is the maximum. Anything below 0 is negative, meaning that if you reduce it beyond, if you reduce it by 3.6%, that means the project will be negative. NPV will be negative. So that is what we are saying here. So let's put the interpretation there. The sales volume should not reduce or fall, should not fall below 3.5%. If not, the investment proposal will not be accepted. Okay, number 5, we have 3 more to go. Number 5, we have to calculate sensitivity margin of variable cost. Sensitivity margin of variable cost, which is equal to NPV of 232 over the PV of variable cost. We don't know the PV of variable cost, therefore we need to go and calculate it. I can say PV of variable cost. So total variable cost is equal to variable cost multiplied by the units produced, which is equal to 18 naira multiplied by 240,000 units. So this will give us total variable cost is equal to, what do you have there?
4,320,000.
4,320,000 naira. So to now get the PV of variable cost, all right, then you need to multiply this by annuity factor. So you then say 4,320,000 multiplied by 4.659. So this will give us, what do you have?
20 million.
20 million,
126,000.
126,
880 naira.
880. All right. So that's the PV of variable cost. So our figures are in millions, sorry, in thousand. I will do 20,127. So here is 20,127 multiplied by 100 over 1. Okay. So the final answer is 232,
It's
23,
1.2, sir.
1.2, 1.2%. So which means that variable cost should not be allowed to increase beyond 1.2%. Otherwise, the investment proposal will not be undertaken. All right? The variable cost should not beyond 1.2%. Otherwise, the investment proposal will not be accepted. Okay, so the maximum increase in variable cost is 1.2%. Any further increase beyond this 1.2, the project NPV will be negative. Then number 6, we are to calculate sensitivity margin of product life. Okay, sensitivity margin of product life. Let me rewrite that. So sensitivity margin of product life is computed as product life minus break-even points of product life over product life, all multiplied by 100 over 1. So from this formula, it means that we need to go and calculate. We already know the product life to be 10 years, but we don't have the break-even points of product life. So we need to go and estimate it. So let's go and do working for that. So divided by 10, then multiply by 100 over 1. So let's go and calculate break-even points of product life. This should be for our interpretation. Then let's start the working here. So we want to calculate break-even points of product life. And we said that to calculate break-even point of product life, there are 3 steps. The first step is to reduce the life of the project by 1. Then you calculate the NPV of the reduced life. Then step 3, you then calculate break-even points of product life using the appropriate formula. So the useful life of this project is 10 years. When you minus 1 from 10, we have 9 years. Therefore, we are going to compute NPV for 9 years. So I will then come here. I will create a column for year, description of items, cash flow, discount factor at 17%, then present value. Year 0, year 1 to 9, 1 to 9. Initial investments, annual contribution, then production costs. Okay. Somebody should give me annuity factor of year 1 to 9 at 17%.
4.451.
4.451. Okay. So here is 4,800. 1,440 and 360 negative. So multiply to get the present value. What you get? Yes,
6409.
6409. 360 multiply by
1602.
4.1602. So the difference is 7. All right, so that's the NPV. So now that you have the NPV, we can then calculate break-even points of product life to be equal to reduced life plus NPV of reduced life over NPV of reduced life minus NPV of normal life, or multiply by normal life minus reduced life. Okay? So, reduced life is 9 years plus NPV of the reduced life, 7, divided by 7 plus NPV of normal life, 232. Normal life is 10 years minus reduced life of 9 years. Therefore, 7 divided by 239 equal, multiply by 1 equal, plus 9 equal. What you get? Give it to me.
9.03.
9.03 years. So the break-even point of project life is 9.03 years. So I would then come here 9.03. So put it in the formula in your calculator. What you get? What's the percentage?
9.7.
9.7%. 9.7%. So the interpretation of this is that the product life should not reduce more than 9.7%. Otherwise, the investment proposal will not be accepted. Put it down. The product life should not reduce. Let me use another word. Should not reduce more than 9.7%. If not, the investment proposal will not be undertaken or will become unviable. Will become unviable. That's it. The last one is sensitivity margin of cost of capital. Number 7. Sensitivity margin of cost of capital, which is equal to internal rate of return minus cost of capital over cost of capital, multiplied by 100 over 1. So looking at this formula, we have internal rate of return. So it means that we need to go and estimate internal rate of return before we can calculate sensitivity margin of cost of capital. So let's come here. Calculating internal rate of return. Now, because we have calculated NPV before, we got 232 using 17%. Let's try 20% and see. If 20% is negative, that means we are going to assume 17% as our discount, our second discount rate. So let's say, assume 20%. We then use this 20% to compute NPV. Yes, Charity, talk to me.
Sir, come again. You said something. You said because we have calculated NPV using what?
17% before.
Okay. Okay.
So we have one NPV, which is 232,000
Yeah.
naira. So
Yes.
that means we can increase to 20% and see if 20% give us a positive, a negative NPV. That means we are going to assume that 17% as our second discount rate. But if this 20% give us a positive NPV, we need to increase it to maybe 25 or 22 to get a negative NPV. All right.
Thank you.
You are welcome. So cash flow discount factor at 20%, then PV. Year 0, 1 to 10, 1 to 10. Initial investments, annual contribution, then production costs. 48 1440 360. So somebody should give me an annuity factor of year 1 to 10 at 20%.
4.192.
4.192. 192. 4.192. So give me the present value.
6,036.
6,000. 6,036. Okay. Then the second one, production cost. 1,000.
509.
509. So what's the final answer? 6036 minus the rest.
273 negative.
273 negative. So we assume 20% discount rate. We got a negative NPV. Therefore, we are going to assume 17% as our second discount rate. Okay, so with this, I can then say internal rate of return equal to lower discount rates plus net present value of the lower discount rate over net present value of the lower discount rate plus net present value of the higher discount rate. Higher discount rates minus lower discount rates. So A, 17% is lower than 20%. So here will be 17 plus NPV of the 17, 232 over 232 plus NPV of the higher discount rate, 273. Higher discount rate of 20 minus lower discount rate of 17. Final answer, what you get? Yes.
18.4.
18.38.
38.
18.38%. That's our internal rate of return. Then go back to our sensitivity margin. So IRR is 18.38 minus cost of capital of 17% over 17% multiplied by 100 over 1. Final answer, give it to me. What do you have?
8.1%.
8.1%. 8.1%, which means that the cost of capital should not increase. Should not increase more than 8.1%. Otherwise, the investment proposal will not be accepted or will become unviable. So that's that. That's end of the question. Let me know if you have any question for me before we move to another one. We are moving to simulation. Let me know if you have any question on this. So like I told you earlier today, in recent time, ICAN usually tests a specific variable instead of having an accumulated variable. ICAN can ask you to compute sensitivity margin of working capital. All right, you can be asked to calculate sensitivity margin of a scrap value. So this usually will be embedded in a particular under a particular requirement. So requirement A, you may be asked to evaluate the project. Number B, the examiner can ask you to do one other thing. Then number C, you may be asked to determine sensitivity margin of working capital, for example. All right. But again, you have to know what you are doing. You must know what you are doing. All right. So that's end of sensitivity margin. Let's go to simulation quickly. I will stop sharing this and then move to simulation to study material. So we have two more to go. After simulation, then we have decision tree. Last diet, question number 2, I think. Was it question number 2 or 3? It was an decision tree, 20 marks. Okay. So let's talk about simulation. Okay, let me just, instead of switching, let me go back to the working notes. Let me use that one to explain it. You can open to the material at your end. Let's talk about simulation. All right. So what do you mean by simulation? Simulation is one of the methods of mitigating risk that relies heavily on random numbers. Okay, let me put it down for you. This is one of the methods of mitigating risk that relies heavily or that relies on the use of random numbers. Okay. It is a trapezoid, or it involves the process of mimicking a model in form of a real-life situation. Okay? The process of mimicking a model. When you copy or imitate, mimicking a model in form of a real-life situation. That means when you do this, it means you are simulating. Oftentimes, in some organizations, for example, let me use, okay, for some of you that work with an organization or that work with a company that's operate from, let's say, high-rise building, for example, okay, all those skyscrapers. Some of you will notice if your company usually do it, or this facility manager, if they usually do it, you will notice that almost every year you conduct a drill exercise whereby you may want to simulate. You want to know what will be how many uh, how long will it take the last person from the last floor to evacuate the entire building. Let's say, for example, you have 10-story building that accommodates over 500 people. Then you want to know, in the event of, let's say, for example, fire outbreak, right? In the event of fire outbreak, how long will it take the last person from the last floor to evacuate the building? So, the actual events may be different from when you are simulating because in the event of if there's any incident, there could be stampede because you are not using elevator. You are going to follow the staircase. You can imagine from the 10th floor to the ground floor. All right. So everybody will try to save his or her life. So you won't know that you are even matching people. You'll be pushing your hey. Everybody wants to go out at the same time. So there could be stampede. So you want to know, you want to simulate how long will it take the last person to evacuate the building. All right. So you in recent time, about some weeks ago, it happened in Lagos when a particular building along Marina axis, got fire. There was outbreak in that building, fire outbreak in that building, and almost about 10 people died in the incident. It's a very sad event for that matter. So this is what we are saying. But again, I don't want to go too much into all of that because of time. But the bottom line is that when you talk about simulation, when you are mimicking a model, when you are mimicking a model in form of a real life situation, that means you are simulating. Okay, you are simulating. Now, examiner can ask you to compute expected NPV using simulation method. The same way you normally calculate expected NPV using expected value method is the same way you are going to do for simulation. But the only difference is just that instead of you to use expected value to compute NPV, you are expected to use the simulation. You are supposed to simulate for each variable of receipt and payment before you calculate your expected NPV. Okay, so let me just put it down so that we'll move faster. Okay. The expected NPV, let me put as a paragraph. The expected NPV, the expected net present value using simulation method is computed by simulating for each variable of receipts and payments, and then use the simulated results to compute, and then use the simulated result to estimate NPV. The resultant figure is what is known as, or the resultant figure is known as expected NPV using simulation method. Okay, so that's all you need to do. Now, the difference is that examiner can ask you to calculate expected NPV. Examiner will just ask you calculate expected NPV. If in the question you are given, because the same way examiner will test the question under expected value method is the same way to be tested under simulation. The only difference is that if it's going to be simulation, examiner will give you random numbers. You can call it random numbers or tag numbers. So that's the only difference. Once in the question you can see random numbers, it means that examiner wants you to use simulation method to calculate expected NPV. So, and I told you, to do this, there are two steps that you are going to carry out. The first step, you need to simulate for each variable of cash inflow and cash outflow. That is, you simulate for receipt and payments separately. Then, you then use your simulated results to go and compute NPV. So whatever you have thereafter represent the expected NPV using simulation method. So now to simulate, this is the format you are going to use anytime you want to simulate for each variable. All right, simulation or formats for simulation. So anytime you want to simulate, this is the format. So whatever the variable, if you are given revenue, for example, you put the revenue as the first column. If you are given variable cost, your first column will be for variable cost. Just put the variable as the first column. Then the next column will then be for probability. After probability, you need to find the cumulative of probability in percentage. Then you create a column for random allocation. This random allocation is just like class interval. Then finally, you create a column for random numbers. Of course, these random numbers, or you can call it tag numbers, will surely may be given to you. All right. So you put the variable here, the cash flow. Let me call it cash flow instead of variable. Of receipt and payments. Okay. You have your probability, then Now, one thing about this simulation is that if you are not in the class, you may struggle to understand how you are picking the numbers, because it's not 1 plus 1 is not equal to 2 as far as simulation is concerned. You are selecting numbers. You are picking numbers on the basis of you are picking numbers randomly. It's not that you are not going to select all the cash flow given to you. You are selecting the numbers on the basis of random number given to you. So, and that's why the expected value calculated using simulation method cannot produce optimal. In fact, let me put it down for you. Note, the expected NPV using simulation method cannot produce optimal solution. Why? Because cannot produce optimal solution because not all cash flows are well represented. Cannot produce optimal solution, but good enough. It can only produce good enough or near optimal. Or near optimal. Why? Because not all cash flows are well represented. So you are not going to pick all the cash flows. You are selecting numbers randomly based on the random number given to you. Okay, you are supposed to, when you are calculating your simulation, you are going to pair. Okay, when you are calculating your, for example, when you are calculating your expected NPV, you are going to pair receipt and payments based on the random number and sets given to you. Okay, so this is how to calculate expected NPV. So like I said, to calculate expected NPV using simulation method, you have two steps. Step 1 is to simulate for each variable of receipt and payment using this format. Then step 2, you proceed to calculate expected NPV using simulation method. So you are going to calculate your expected NPV on the basis of the sets given to you in the question. So you can have about 5 sets. So if you are given 5 different sets for each of the variables, that means you need to calculate 5 different NPVs. If you are given 10 sets, you need to calculate 10 NPV. If you are given 2 sets, then you need to calculate 2 different NPVs. Then you find the average. All right. So that is that. I will stop sharing this and move to the the question bank. Let's have illustration on this, and let's see if we can do decision tree tonight or after this question we'll stop. All right. We're almost getting to the end. After risk and uncertainty, we are moving to margin and acquisition. Margin and acquisition is purely theoretical, no calculation. The calculation will be done under business valuation. Okay. Let's have this illustration number 9. Is it 9 or 7? Sorry. Illustration number 6. Equity Pro. Let's have this illustration number 6. Equity Pro. Yes, who is helping us to read? Some of you have disappeared. I trust you. Yes, who is helping us to read?
I so.
All right, go ahead, Vijay.
Equity Pro Limited has prepared the following probability estimate for a proposed investment project. So the initial outlay, okay. Cost of
Yeah.
capital is 12%. Required. Calculate the net present value of the project. B. Analyze the risk inherent in this situation by simulating the NPV calculation. You should use the random numbers given at the end of the question to simulate three sets of cash flows. On the basis of your simulation results, what is the expected net present value? C. Explain briefly why the expected net present value calculated in A and the one calculated in B may not necessarily be the same.
All right.
That's
Thank you very much, Uju. Now, it's
okay.
been a while that ICAN tested simulation question. All right, it's been a while. So you never can tell what what is coming in November. The same way last diet, for a very long time, ICAN did not test decision tree. They just came they came back last diet at 20 marks question, you know, and then say, okay, this is decision tree, and a very straightforward kind of a question. But if you don't know how to construct your tree diagram, you cannot get that question correctly. 20 bonus marks. But that notwithstanding, let's move on. But the important thing is that you just have to try as much as possible to cover the substantial part of your syllabus, because you don't know where examiner will come to you. It may be the topic that you are avoiding, that you think that, okay, ICAN has not been testing this, it won't come out. ICAN can just go there and then set it. And then you can see, you don't know. So, and that's why it is important for you to cover your syllabus, so that wherever examiner is coming to you, you'll be able to do justice to the questions. All right. So let's solve this. We want to calculate NPV. Let me stop sharing and move to the working notes. So examiner is asking us to calculate NPV. Solution to illustration 6. That's page 64. Page 64. 64. So examiner is asking us to calculate, we have to calculate the NPV of the project. Pay attention. Examiner is asking you to calculate NPV of the project. When you look at this question, when you look at the table, you are given probability and cash flow, so which means that you need to calculate expected value first. Before you can calculate NPV, you must calculate expected value for both receipt and payment. Receipt is the revenue, payment is the running cost. So you need to calculate expected revenue and then expected running cost. You then use your expected value to go and calculate the NPV. So I will come here. The name of the company is Equity Pro. Limited. So number A, first thing first, I need to calculate expected revenue. The reason why we are calculating expected revenue is because we are given probability and cash flow. So which means that I must calculate expected value first. So to do this, to get your expected revenue, you are supposed to multiply probability with the cash flow. So I will create a column for probability, then revenue, then expected value. So probability is P, revenue is X, expected value is probability multiplied by cash flow. So give me the cash flow, give me the revenue for each as given.
40,000,
40,000,
50,000, 55,000,
and then
60,000.
60,000. So these are the revenue attached to each state of nature. So give me the probability.
0.15, 0.40,
Next,
0.30,
and then
0.15.
okay. So to now get the expected value, expected revenue, you are supposed to multiply the probability with the cash flow. Therefore, what's 15% of 40,000?
6,000,
Okay. 6,000. Next, 20,000.
16,500.
Pardon?
16,500.
16,500.
9,000. 9,000, the last one.
9,000. Okay. So let's add up.
51,500.
51,500. So the expected revenue is 51,500. Again, I will calculate expected running cost. Can I use the others? Okay, let me use this other side. Expected running cost. The same way we compose the expected revenue, create a column for probability, then running costs, expected running costs. Give me the probability first. 0 points.
0.4
Okay.
is 0.25. 0.35.
35. So that gave us 100%. Okay. So give me the cash flow.
25,000. 30,000.
And then
35,000.
35,000. So we need to calculate the expected running cost. 40% of 25,000. What you get?
10,000 naira. 10,000.
12,000, right?
10,000. 10.
Okay,
10,000.
10,000. Okay.
7,500.
7,500.
12,250.
12,250. That's 29,750.
750.
So yeah. So now that we have computed expected revenue and then expected running cost, we can then proceed to calculate expected NPV. So requirement number A, calculating expected net present value. You can see in the requirement, examiner did not mention expected NPV. So it's implied that you know what you are doing. All right, so create a column for year. Description of items, cash flow, then discount factor. What's the cost of capital given in the question?
12%.
12%. Year 0, the useful life is 5 years. So year 1 to 5, year 1 to 5. Initial outlay, we have revenue. We also have running costs. We calculated, what's the initial outlay?
40,000.
40,000.
40,000 is the initial outlay. So we calculated expected revenue to be 51,500. Expected running cost to be 29,750.
750.
So somebody should give me annuity factor, year 1 to 5 at 12%.
3.605.
3.605.
Okay, 3.605. So multiply with 51,500.
185,000.
185.
658.
658.
107.
107.
249.
609.
No, 249. 249.
249. Final answer. $38,409.
409.
You then say the expected NPV is 38,409. So that answers A requirements. Then requirement number B. Examiner is asking you to analyze the risk inherent in this situation by simulating the NPV calculation. You should use the random number given at the end of the question, whether you are told that or not. Once you can see random number in the question, it means that you are to calculate expected NPV using simulation method. So in this table given to us in the question, we are given 3 different sets for revenue and then running costs. So it means that we are going to calculate 3 different NPVs. Okay, so to solve this question, let me move to the next page. So requirement number B. Now, to calculate expected NPV using simulation method, the first thing first that you need to do is to simulate for each variable. You simulate for revenue, you also simulate for running cost. You then use your simulated result to compute NPV. Okay, so quickly, let's simulate for revenue. Simulating for revenue. Okay. So you are supposed to create about 5 columns. The first item will be revenue, followed by probability, then cumulative of probability. This will be in percentage. We create a column for random allocation, followed by random numbers. So like I said, examiner can call it random number or tag number. It's the same thing. So I will then pick the revenue for each year. The revenue for each state of nature as given to us. The first revenue is 40, 50, 55, 60 in that order. So here is 40,000, 50,000,
55,000.
55, and then
60,000.
60,000. The next item will then be the probability. Let me write this too.
0.15.
0.15,
0.4.
0.40,
0.30.
0.3, and then 0.15.
0.15.
Okay. Now, so now find the cumulative of probability in percentage. Let me complete the table first. So to find the cumulative of probability in percent, the first probability is 15%. So here will be 15. 15 plus 40, 55%. 55 plus 30 will give us 85. 85 plus 15 will give us 100%. Okay? Now, like I said, the random allocation is like class interval. So you are starting from 0, 0 to you are going to use the cumulative of the probability to derive your random allocation. You use your random allocation to derive your to assign your random numbers. Therefore, the first probability is 15%. 1 minus 15% is 14. After 14 is 15. 1 minus 55 is 54. After 54 is 55. 1 minus 85 is 84. After 84 is 85 to 99. I will then go to the question. The random number given to me for revenue, what do you have? Which figure do you have for random number under revenue?
30.
30. So you now look at your random allocation. You look at your random allocation within the range. Where do you have 30? 30 will fall here. Here will be 30. What's the second random number for revenue?
20.
20. 20 is the same place. Then set 3, revenue. What's the random? 70.
9.
79. So here is 79. So with this, we have simulated for revenue. You do the same thing for running costs. Simulating for running costs. Okay. So we have the running costs. Probability. Cumulative of probability in percentage. Then we have random allocation. Then random number as given. Okay. So for the running cost, give it to me. What do you have? Give me the running cost.
25,000.
25,000.
25,000.
25,
30,000.
30, and then
35,000. Yeah.
Okay. Probability.
Is 0.40. 0.40. 0.25.
And then
0.35.
35. So the same way we did for revenue.
0.4.
This one will be 40%
40.
plus
65%.
25, 65%.
100%. Sorry, 100.
Okay.
65.
then
100.
100. So starting from 0, 0, 1 minus 40 is 39. After 39 is
40 to
40,
64.
64. Then
65 to
65
99.
to
99.
99. So give me the random number for running cost.
71.
71 will fall in the third line. Here
The
is
third line, yes.
71.
Then 0, 0, 0, the first line.
0, 0.
And the last line, and 94.
94 is here. Again, with this, we have simulated for running costs. This is one first step. The second step is to now use the simulated results to compute NPV. To do this, you are supposed to pair revenue with running costs for each set. We are given 3 different sets in the question. That means we are going to calculate 3 different NPVs. Therefore, I will then say calculating expected NPV using simulation. Methods. So we are going to do it set by set. For set 1, we want to calculate NPV for set 1. All right. So create a column for year, description of item, cash flow, discount factor at 12%, then present value. All right. So here will be year 0, 1 to 5, 1 to 5. Initial outlay, revenue, then running cost. $40,000. Now, for set 1, go back to the table given to us for random number. For set 1, what's the random number for revenues?
30.
30. So we then go to where we have simulated for revenue. 30 is here. So you now trace it to the left. Under 30, the revenue we have there is 50,000 naira. So here will be 50,000. Set 1 for running cost. What's the random number given?
71.
71. This is where we indicated 71. So the cash flow is 35,000. $3.605. 605. 40,000. Therefore, 50,000. 50,000.
180,000.
180,000. 180 what?
180,000. 250.
250.
Yes.
35,000 multiplied by 3.605.
126, 175. 126, 175.
175. Final answer.
266, 425.
266. No.
125.
14078.
14075.
Oh, so sorry.
14075. Okay.
No, it's not correct though.
What is not correct?
Okay, sorry.
14075.
Correct.
All right. So set 2. For set 2, we can put NPVs the same way as set 1. So create a column for year, description of items, cash flow, discount factor at 12%, present value, year 1 to 5, 1 to 5, initial outlay, revenue, then running costs. So initial outlay still remain 40,000 multiplied by 1, 40,000. Now, for set 2, what's the random number for revenue?
20.
20. So you then go to where we have simulated for revenue. 20 is the same place, 50,000. 50. Multiply by 3.605. That's 180, 182.50. Then running costs.
0.
Set 2. What's the random number?
0. 0.
00. Okay. Under 00, we have 25,000 naira. Running costs under 00 random number is 25,000 naira. So 25,000 multiplied by 3.605. What you get? Yes,
Okay.
90125.
125. Final answer,
5125.
50,000.
5125. So the last one, set 3. Yeah. 0, 1 to 5, 1 to 5. Description of items, cash flow, discount factor at 12%, present value. All right. So initial outlay, revenue, then running costs. ₦40,000 multiplied by 1, 40,000. Set 3, tag number for revenue is
79.
94. Sorry, is 79. Okay, then you trace it to the left.
55.
That's 55,000 naira. Here will be 55,000. Then running costs.
35,000.
35.
So running costs tag number is 94. We trace it to the left. We have 35,000 naira. Multiply by 3.605.
198,275.
198,275.
126, 175.
125.
75.
175.
32, 100.
3 to 100. Now, you can see that we have three different sets of NPVs. Therefore, you need only one answer. Therefore, you need to find the average expected NPV. So I would then say average expected NPV. To do this, you are supposed to add all the NPVs together. Then, because we have three different NPVs, then you add up the entire NPV divided by 3. So 5125 plus 32,100. Everything divided by 3. So what do you have here?
100. 32,
Pardon?
100. 32, 100.
32,100.
100.
That's the expected NPV. So I
Is
would
it
then say,
coincidence?
pardon?
Is it coincidence that the last one is
It's just by chance. It's just by chance. The average expected NPV is using simulation method. The average expected NPV using simulation method is 32,100. So that answers number B, requirements. Number C, finally, number C, examiner is asking you to briefly explain why the NPV calculated in A and the one calculated in B may not necessarily be the same. Why are they not the same? All right, of course, they will never be the same because different methods are employed. Okay, in A, we use expected value method to compute NPV. In B, we use simulation method to compute NPV. Therefore, the results will not be the same. All right. When you look at the simulation method, you see that we are selecting our cash flows on the basis of the tag number or random number given to us. And then we ignore some cash flows. When you look at, for example, revenue, the highest revenue is 65. We did not even, sorry, it's 60,000 naira. We did not even select it. All right. So because you are picking numbers randomly, you cannot have optimal solution. The worst case, I mean, the best you can achieve is to have near optimal or good enough solution. So let's answer that number C requirements and then we close the class. Number C, examiner is asking, why is expected value in A and B not the same? You then say the expected NPV NPVs calculated in A and B above will not be the same. Will not be the same. because it's not this will not be the same because different methods are employed. Okay, in A above, expected value method. Expected value method produced expected NPV of 38,409, whereas the simulation method in B above produced expected NPV of 32,100. Is that one? Is that one 38,149? Let me confirm. 38.
Correct, sir.
Yes, thank you. 38,409. Just want to be sure. Okay. Produce expected NPV of 32,100. We've already answered the question by saying that because different methods are used. Okay, so that's why they are not the same. However, the expected NPV calculated using the simulation method will not produce optimal solution but near optimal or good enough. This is because not all cash flows not all the cash flows. Let me write it. Not all the cash flows are selected. Okay, when calculating the NPV, we are selecting numbers on the basis of the random number given to us. So that answers the question. Let me know if you have any question for me. That's end of this exercise. So we have one more to go. After simulation, we are moving to decision tree, and it's not something we can do today. It takes time. All right. So we continue in our next class by the grace of God. Let me know if you have any question for me so that we can close the class. All right. So in the absence of no further question, I want to say thank you for joining the class. I will see you again next week, Monday, by the grace of God. Good night, everyone.
Good night.
Yeah, good night, Uju.
Good night, sir.
Thank you, sir.
Chino. All
Thank you,
right, good
sir.
night. Good night, Wumi.
Okay.
Good night. Okay.